In this video, we're going to learn how to record bond investments, but using fair value through OCI. So it's very similar to doing bonds at amortized cost. The only difference is at the year end, we end up adjusting the bond value to fair value. And then if it's through OCI, when we do derecognize the bonds once we sell them, we'll have to recycle any of the unrealized gains or losses from accumulated other comprehensive income into retained earnings. So it's really a blend of the methods we've already used. So let's take a look. On July 1st, 2020, Myron Aggregates Ltd. purchased 6% bonds having a maturity value of $100,000 for $103,585. The bonds provide the bondholders with a 5% yield. The bonds mature 4 years later on July 1st with interest receivable June 30th and December 31st of each year. Myron uses the effective interest method to allocate unamortized discounts or premiums. The bonds are accounting for using the fair value OCI model with recycling, and Myron has a calendar year end. So I'm just going to stop there. What I'm going to do is set up the amortization table using the effective interest rate method for the bonds. So the interest expense is going to be the yield, so that's the 5%. And I'll just highlight this as we go along. And the carrying value, so I want to start out with my present value, so that's what I'm going to calculate. Now they tell me it's 103,585, but I just want to double check to make sure. And then my face value is going to be 100,000. So if I calculate my present value, I'll go to the formulas, go to financial, and then scroll down to present value. So the rate is the yield, so 5%, but remember the bonds are paying June 30th and December 31st, so they're paying twice a year, so I have to divide the rate by 2. The number of payments, well, it says it's 4 years, so I times that by 2, so that means there's 8 payments, 2 per year. Now the payment amount is always on the face value, so I'm going to take the 100,000 and multiply that by the stated rate. Now the stated rate of the bond is 6%, so that's the rate the bond has to pay in interest per the actual bond contract. So I get 6,000. But again, I'm just going to divide that by 2 because you're paying it out twice a year. And the future value is the face value, so that's 100,000. So now we'll see that I got 103,585, which is the present value that I want. Okay, so the cash received that I'm receiving every time I have a bond payment, let's just put in all of these amounts. We said there were 8 payments. And that was 100,000 times by the 6%. So remember, that has to be the stated rate of interest. And that's the actual interest on the contract. And divide that by 2. So we're going to be doing 3,000 each year. So we'll receive the cash. That's how much I'm going to receive per my bond contract. Now my interest income is going to be calculated on the present value of the bond times by your interest income. And again, that interest income is the yield, and we have to divide that by 2 because it's paying twice a year. And the amortization will just be the difference. So I'll just take 3,000 minus 2,589.63. And I'm trying to end up with 100,000 down here. So I know that I actually have to subtract this number. So before I pull the schedule down, I just want to lock this C11 cell. So it'll take everything by 5%. So remember, when I'm calculating the interest income for the second bond payment, I'm going to take the 103,174.7 and multiply that by 5%. Okay, so now that I see that my face value is 100,000 at the end of the 8th payment, I know I've done my bond amortization table correct. Okay, so let's start doing all of the journal entries. So on July 1st, 2020, when I purchased the bond, I'm going to debit fair value through OCI investments, and that's for my 103,587, and then I'm going to credit cash for the same amount. And I'll just say to record purchase of bond investment. So remember, this is an investment on our books, so it's sitting as an asset. So now December 31st comes along, and that's when I'm going to receive my first interest payment. So my bonds are actually paying June, interest on June and 30th, and luckily they're paying interest on June 30th and December 31st, and luckily December 31st is my year end, so I don't have to worry about any interest accruals. So the first interest payment I'm going to make is this one. So December 31st, 2020, I'm going to debit cash for this $3,000. I'm going to credit my fair value through OCI investments for the amortization, so that's 410.37. Now I know I have to credit that because my bond is sitting as a debit and I'm trying to make the balance smaller. So then I credit that account to bring it down to 103,174. And I'm going to credit my interest income for the 2589.63. And I'll just say to record collection of interest. So if we were using amortized cost, we would just stop there. But now what happens, maybe I'll just add this to the table, is under fair value through OCI, we're going to adjust the value of the bond to its fair value. And then we're going to run the unrealized gain or loss through comprehensive income. So it says that my fair value at 2020 is 103,400. So let's put that in, 103,400. So I'm going to have to do an increase there. So I'll do December 31st, 2020. So the increase, if I just take the difference, and maybe I'll show all of the decimal places here. And I'll show the decimal places on my journal entries too. So the difference is 225.3. So I just took the difference between the 103,400 and the 103,174.7. So I'll debit my fair value through OCI investments. Don't know why these keep coming up as italics. For the 225, and then I'll credit my unrealized gain or loss through OCI. So the difference here between a fair value through net income investment and a fair value through OCI investment is when we put it through net income, this part of the journal entry will go through the income statement. But when we're putting it through OCI, this part of the journal entry will go through OCI. and then close into accumulated other comprehensive income on the balance sheet at the year end. So I'll just say to record fair value adjustment. Okay, now our next step is to record the collection of interest on June 30th. So I'll say June 30th, 2020. I'm now going to do this line here. I'll just highlight that one in green. So I'll debit my cash for $3,000 and I will credit my fair value through OCI investments for the $420.63, and then I'll credit my interest income for the $2,579.37, and I'll say to record collection of interest. And then December 31st rolls around of 2021. Sorry, this should say 21. So now I have to record this one. I'll put that in orange. So December 31st, 2021, let's just repeat this journal entry. So I'll just copy it just to save myself some time. But instead, let's grab the numbers on the orange side. So that's the cash. This is my amortization. And then this is my interest income. So basically, I've recorded all of my interest payments up to this point in time. So now it says that assume fair value adjustments are recorded at year end only. And so my next fair value adjustment at 2021 is this amount here, $102,200. So I'll have to go ahead and record that fair value adjustment. And then what I'll do is after I record that fair value adjustment, I'll record the sale. So December 31st, 2021, I'm going to debit my unrealized gain or loss through OCI, and I'm going to credit my fair value through OCI investment. I guess I should have done the calculation before setting up this journal entry because it could easily go the other way. Okay, so I have to just see what my current balance is. So this was everything if I carried it at carrying value. But since I made this adjustment last December to fair value, look what happens. I'd have my last recorded value of $103,400, and then I would subtract this amortization amount because that was a credit into the bond account. So that brings my balance down to $102,979. And then again, if I take that last balance and I subtract the 431.15, then that gives me a balance of 102,548.22. So now what I need to do is make an adjustment for that difference because I have to bring it down to, what's that number? 102,200. So if I do $102,548.22 minus the $102,200, that's an adjustment of $348, and I'll just show you the rounding on there. So 348.22. So again, I'll show you that amount. So that number was 102,548.22, 102,548.22 minus, there's the fair value adjustment, 102,200, 102,200. So I'm just double checking my math, which is correct. So if I put that little adjustment through right here, so I just double check it here as well. So that's 348.22. So I'll just go minus 348.22. Then that will give me now that balance of 102,200. So that is the correct adjustment. So now that my bond is sitting at 102,200, I can now remove it from the books. So none of this is going to happen. We're actually going to credit the bond account for 102,200 and derecognize it. So this adjustment was a bit tricky, but that was to record fair value adjustment to date of disposal. And then we'll remove it from our books. Cash for 102 and fair value through OCI investment. Okay, now the last thing that I need to do is now reclassify my accumulated OCI into retained earnings, because now I've derecognized this bond. And so I'm basically talking about, I'll just highlight them in red. So let's see here. This amount went into accumulated OCI. This amount went into accumulated OCI, as well as, are those the only two? 1 revalue, 2 revalue. Yeah, just 2. So I can just easily take the difference instead of opening up an OCI account. So I'll just say December 31st, 2021, debit loss on disposal of investments, fair value through OCI, and then credit unrealized gain or loss OCI. So this one we're recycling through net income for the difference. So that's this minus this. To reclassify unrealized gains or losses by recycling through net income. So let's just double check that the question asked us to do that. Okay, so the question doesn't specifically tell us to recycle through net income, so there's actually 2 ways we can do this. Oh, it does say it. I should learn to read. I'm going to highlight it here. The bonds are accounted for using fair value through OCI model with recycling. So when we recycle that through net income, we do this journal entry. And I'm just going to highlight this in yellow because I'm just going to modify this question slightly. If we don't recycle through net income, then the journal entry would be this. Debit to retained earnings of 122. So we're bypassing the income statement. And then we would credit accumulated other comprehensive income for 123 with the decimal places. Okay, so I just want you to be aware that when we're dealing with fair value through OCI investments, whether or not it's on a bond or if it's on shares, if they ask us to recycle it through net income, we'll do that. We'll put it as a gain or loss and move it out of OCI. If they tell us not to recycle it through net income and put it through retained earnings first, then we're just going to directly debit or credit retained earnings and clear out the accumulated other comprehensive income account. And that's it.